XRP long liquidations just spiked 832%. Here's what it means to price rally. So, the question is, why did XRP just witness a staggering 832% liquidation explosion? So, we are going to break down right here a massive structural earthquake that just rocked the XRP derivatives market. If you have been watching the charts lately, you know things have felt heavy. But what just happened behind the scenes is absolutely unprecedented for recent months. We have just witnessed one of the most aggressive deleveraging events in recent history, with XRP long liquidations skyrocketing by a mind-boggling 832% above the 3-month average. In a single brutal trading candle, $6.7 million worth of leverage bullish bets were completely wiped out. This isn't just a minor blip. This is a complete clearing of the board. So in this video, we are diving deep into the freshly released CryptoQuant data spanning from late March through late June 2026 to figure out exactly what this means for the future of the price. Is this the ultimate capitulation before a massive rally, or is there more pain ahead? So let's unpack the data together. Let's start with our very first question about what does the CryptoQuant chart reveal about the $1.05 floor. So, to understand how we got here, we have to look back at how the price has behaved over the last 90 days. Throughout April 2026, XRP was putting up a solid fight, trading comfortably within a stable range between roughly $1.30 and $1.50. But as we move into May and early June, a sustained decline took hold, dragging the asset down toward $1.10 mark. That brings us to the final days of June, where the price slipped to its lowest level in this entire data set, hovering near $1.05. It was exactly at this $1.05 local bottom where the trap snapped shut. The massive $6.7 million long flush materialized as a giant red spike on the liquidation charts, completely dwarfing every single prior liquidation event visible in the quarter data. Now here's my opinion. When you look at this chart breakdown, it becomes glaringly obvious that retail traders were over-leveraged and heavily biased on the upside while the asset was drifting downward. They were trying to catch a falling knife between $1.30 and $1.10. This final $6.7 million flush felt like a forced liquidation event engineered to completely cleanse the system. So in my view, seeing the biggest liquidation spike happen precisely at the lowest price point is a classic sign of a market structural reset. The weak hands have officially been shaken out. Now, how does deep negative funding fuel a potential short squeeze? The second panel right here, introduces the most fascinating part of this entire event. The Binance funding rates, and that's the Binance funding rates. While funding rates were highly mixed and indecisive throughout April and May, this June 2026 saw a dramatic shift. Funding rates plunged consistently and deeply into negative territory. Market analyst Saif Crypto right here flagged this exact setup right here on X, explicitly stating that this combination of factors represents bearish sentiment that simultaneously acts as prime short squeeze fuel. When funding rates turn deeply negative, it means the market has become so overwhelmingly bearish that short sellers are actively paying long holders a premium just to keep their short positions open. Now, here's my opinion about this. This is exactly where the tables can turn overnight. When the crowd rushes to one side of the boat tends to flip. When short sellers aggressively piling in at the absolute bottom near $1.05 and paying premium fees to do so, they have left themselves completely exposed. If a sudden wave of spot buying enters the market, or if positive news breaks, the price will tick upward. This will force those over-leveraged short sellers to buy back their positions to avoid liquidation, creating a cascading domino effect that can rocket the price upward in a matter of minutes. Now, why is this position reset actually healthy for the next price rally? To truly grasp the significance of an 832% spike in liquidations, we have to understand what a position reset actually does to market mechanics. Throughout this entire quarterly period, short liquidations remained relatively quiet and contained. In stark contrast, long liquidations spiked repeatedly, culminating in that giant $6.7 million peak. This asymmetry proves that the market was carrying an immense amount of toxic over-leveraged weight heading into this June decline. As the analyst Saif pointed out, this massive liquidation event acts as a vital market reset. It violently clears out the over-leveraged long positions that had accumulated during the previous higher price ranges. By wiping these positions off the books, the market eliminates the constant, lingering selling pressure caused by margin calls and forced automatic selling. Now, here's my opinion. Think of this leverage reset like clearing out dead weight. When a market is bogged down by too many traders using 20 times or 50 times leverage, the price cannot build a sustainable foundation because any minor downward tick triggers forced liquidation. Now that this massive flush has completed, the toxic leverage is gone. Historically, when a market completes this type of thorough cleansing, it moves away from wild, volatile drops and enters a period of lower volatility compression. This quiet, sideways consolidation is exactly the foundation smart money uses to accumulate before the next major directional expansion. Now, what does the divergence between futures and spot holders tells us? While the derivatives and futures markets were experiencing an absolute bloodbath, something entirely different was happening in the spot market, where real investors hold the actual asset without leverage. On-chain metrics reveal that despite the price tumbling down to $1.05, Binance actual XRP spot reserves only drop by a minuscule 0.35% week over week. Now, here's my opinion. This 0.35% drop in exchange reserves is the ultimate silver lining. It proves that there is a massive divergence between short-term paper traders and long-term asset holders. The retail future traders were panicking and getting liquidated, but the actual spot holders refused to move their tokens onto exchanges to sell them off. they stood their ground. This tells me that the selling pressure is purely artificial, driven by the derivatives market rather than structural capitulation from long-term believers. With the futures market now completely emptied of excess longs, the underlying spot market stability shines through. And finally, here's our overall conclusion. When we look at the entire picture, the narrative changes from a scary price drop to a calculated market evolution. The staggering 832% surge in long liquidations, the historic $6.7 million single candle flush, and the deeply negative funding rates all point to a singular conclusion. The leverage has been thoroughly washed out of the system. XRP has completed a violent positioning reset right at its macro low of $1.05. Because the spot market indicators show that long-term holders are completely unfazed, the immediate selling pressure has drastically dried up. Moving forward, we should anticipate a period of tighter, lower volatility price compression as the market stabilizes. However, because of funding rates remain deeply negative, the market is now a powder keg of short squeeze fuel. The excessive bearish sentiment has set a trap for the shorts, and the next structural move could be an aggressive, swift expansion upward once the consolidation phase concludes. So we need a very close eye on the funding rates and stay disciplined. And this finally ends our video. Thank you very much for watching and see you on the next one. Or you might just as well check this recommended video right here.